Well, in India, traditional investment classes that carried minimum or no risk have been the preferred investment route for the older generations. Now, while the younger set of investors are slowly gravitating to more profitable pastures, many still struggle to keep doubts in check when it comes to non traditional investments or those that have a certain element of risk. Now, the narrative around mutual fund investments and how they are managed can look too complicated for new investors. And this is where passive investing and passive funds could fill the gaps for investors who are finding it difficult to navigate the waters of actively managed funds. Now, asset allocation objectives and maintaining the right levels of diversification in one's portfolio can become a simplified endeavor with passive funds, and that too much lesser costs than what investors incur on active fund management. Yes, the buzzword around passive funds has been getting stronger, and more investors are jumping onto the bandwagon. A report by BCG on the global asset mix of mutual funds showed that the AUM, or active funds under management of passive funds, was pegged at $22 trillion in 2020, which is expected to rise to $34 trillion in 2025. Now, the data from the Association of Mutual Funds in India shows that the net assets under management of passive schemes that stands at 4.72 trillion rupees as on December 2021 compared to 2.94 trillion rupees in December 2020. Now, that's an increase of 60.5%. Now, the rally here may stay, and several factors are catalyzing this, such as market linked returns, negligible tracking error, diversification, and transparency in portfolio composition. Now, investors are also eyeing passive funds with renewed enthusiasm because passive funds may serve varying needs. There are chances that investors might be able to manage downside protection to portfolios without losing out on the potential offered by domestic markets. Now, to throw more light on the phenomenon of passive investing emerging as a preferred path for investors and how it may be a smart way to ace asset allocation, Mirae Asset Investment Managers India Private Limited is hosting this discussion where we will delve into the gamut of passive funds and how their addition to your portfolio may be advantageous. I'm your host, Gautam Srinivasan, and today we have with us Siddharth Srivastava, head of ETF Products at Mirae Asset Investment Managers India Private Limited, Rishad Manekia, who's the founder and MD of Kairos Capital, and Hemendra Gandhi, founding partner of Compass Finserve LLP. Gentlemen, great to have you on board to provide your expertise on the topic. Siddharth, let's start with what are the different types of passive funds and why they are becoming popular?
So, Gautam, first of all, passive funds aim to provide returns similar to the underlying index. For example, a Nifty 50 passive fund will try to give investor returns corresponding to the returns which Nifty 50 is generating. So it's really simple. Whatever the underlying index strategy is, portfolio is, the fund passive fund replicates that and tries to give the returns which is similar to the returns of the underlying index. Now there are majorly two type of passive funds, index funds, which works like a normal mutual fund. For example, a Nifty 50 index fund will hold all the 50 stocks which are part of Nifty 50 in the exact same proportion and deliver the similar performance. The second are ETFs, which are structured like mutual funds. For example, a Nifty 50 ETF will also invest in 50 stocks in the same proportion as they are present in the Nifty 50 index in order to generate similar returns. But they are traded on exchange. They can be bought and sold on stock exchanges at prices around the intraday net asset value. So index funds can be bought and sold at day end NAV, just like normal mutual funds, whereas ETFs can be bought and sold on stock exchanges based on prices around intraday net asset value. So that's the difference between ETFs and index fund predominantly, and both are the prominent vehicles for passive fund investments. Now, there are two major reasons why passive funds are becoming so popular. First is that as market evolve and become more efficient, like India has, it becomes very difficult for active fund manager to outperform the market, and that too on a consistent basis. For example, in last 5 years, Nifty 50 has outperformed 90% of large cap schemes, both if you're talking about a direct plan or a regular plan. So as people start noticing this factor, more and more people starts to invest in passive funds. This happened around 30 years back in US, where the trend towards passive investment started, and it is now happening uh, in India. And secondly, since passive schemes like ETF simply tracks the underlying index, it comes at a very low cost. For example, the average TER of Nifty 50 ETF is just around 0.07% or 0.08%, whereas the TER of a regular plan of a large cap fund is around 2.2%, and TER of a direct plan on an average for a large cap fund is around 1.1%. So the major reason for popularity is first the underperformance of active schemes, whereas passive schemes continues to give you uh, market returns. And the second is obviously the low cost of the passive funds, which becomes a very attractive proposition for the investors.
All right, as they say, variety is the spice of life. But let's see what's the size of the main course when we talk about passive funds. Rishad, let me bring you in. Could you throw some light on what is the size of the passive fund industry and what options are available for investors in this category?
Um, Thanks. So, as Siddharth just mentioned, this industry has grown massively over the last 4 or 5 years. Uh, I think 3 years back, the passive fund industry was maybe less than 1.5 lakh crores. Today, that's maybe over 5 lakh crores. And the number of schemes that are there have multiplied, more than doubled. In fact, I think there are about 230 schemes today, and maybe 3-4 years back there were about 100 or 110 schemes. So you can see tremendous growth in this industry. You can see that when it comes to the different types of options, earlier it used to be a very limited set, maybe limited to the large caps and large mid caps, like the Nifty 50, Nifty Next 50, and maybe the small caps to some extent. But today you have a variety of options for all investors. You get large cap, mid cap, small cap. You get international funds. You get fund of funds, asset allocation funds, thematic funds, international thematic funds. So the options are very vast. And so it's very good for end investors because it enables them to invest how they see fit.
Absolutely. And we have seen the options for investors grow exponentially, and that way they can actually practice good asset allocation to reach their goals. Hemendra, let me bring you in. Why should investors explore fund of fund for asset allocation in passive funds? How do they work?
Okay, so thank you. So let's understand what the fund of fund actually does. So fund of fund will actually invest into the units of the existing schemes, the passive or maybe the active schemes. So passive funds, you have a lot of ETFs that are available, which tracks a particular market segment. So you have mid cap ETF, you have small cap ETFs, you have thematic ETF, you have sectoral ETFs. Uh, so the fund of fund can combine multiple ETFs into a single scheme, and it can offer a solution oriented scheme to the end investor depending on what he or she would want to invest into. So it's a base, to summarize it provides you a convenience of investing into a multiple ETF through a single scheme.
All right. Expanding that conversation, Siddharth, you mentioned earlier about the reasons for popularity of passive funds, but looking at it from a pure investor perspective, who's interested, who's watching this presentation, could you list out the various advantages of these funds, maybe for specific profiles of investors, if you could?
So, if you're talking about fund of fund here and taking cue from the last question itself, see, fund of funds are becoming popular because they provide an option to people who do not have a demat account or who do not have a broking account or do not want to buy and sell ETF unit on exchange due to various reasons, right? Liquidity is one concern which people typically have. People obviously at times are not sure whether they are buying and selling at the right prices, so they don't want to get into the nitty gritty of understanding and buying ETFs on exchange. For them, fund of fund provides a very convenient route to take exposure in ETF scheme. For example, a fund of fund can be based on a manufacturing ETF. Fund of fund can be based on a Nifty 50 ETF, and through this vehicle, the investor can take exposure where he does not require to buy and sell on the exchange, but through a fund of fund vehicle which is feeding into the underlying ETF, he can get the exposure of the ETF scheme. Fund of fund also helps investor to use facilities like SIPs, STPs, etc., which is not available for ETFs from the AMC directly. And lastly, if fund of fund is investing in multiple ETFs, so fund of fund typically can be a single scheme based where it is just feeding into one single scheme. In that case, it is simply trying to replicate the performance of underlying ETF, providing a different route to investment. And there can be a fund of fund which is investing in multiple ETF. In that case, they allow investor to gain exposure in multiple ETF through single scheme, and this scheme typically manages and changes the allocation with changing market condition, and obviously try to generate some alpha because of this allocation process. In doing so, it also absorbs the tax incidents associated with portfolio churning if investor would have uh, done this by himself.
All right, Rishab, you have a point to add about financial goals here. Take us through what you want to share.
Yeah, so passive funds and ETFs as well can form a great tool for investors to meet their financial goals. There's no, it's time tested to show that asset allocation with regular rebalancing is one of the best ways for the investor or the retail investor to get the best risk adjusted returns. And passive funds help reduce a lot of the headache when it comes to that, because they remove fund manager risks, they increase simplicity and transparency in the products. You can easily, create a portfolio even with debt, with certain target date maturities. So, passive funds as a vehicle and ETFs as well. Can help an investor really plan for their financial goals in a much better manner than before.
All right, but adding to that, Rishad, cost is an important reason behind the popularity of passive funds, but aren't fund of funds more costly?
It depends. If an investor was to do it themselves, they would face a lot of other costs as well. It really depends on the cost of the underlying funds. For example, although international funds are not available right now for investment, most of the international fund options are active fund options. So it may be cheaper for an investor to invest in a fund of funds, which is of a passive fund abroad. And similar is the case for domestic funds. It really depends. The answer is not so straightforward. It depends on what you're looking at. But definitely, the case can be made that a passive fund, or even a fund of funds, passive fund of funds, is far more transparent and far lower cost when compared to a more actively managed fund, and even specifically regular plans of such funds.
All right, basis the benefits then that we have heard, Hemendra, how should investors choose the right fund of funds which do allocation in passive funds? What are your suggestions?
As an investor or as an advisor, what we would look at, whether it's a fund of fund or whether it's an active fund, choosing the right fund would depend on what the customers or the investors' risk profile is. So ideally, he should be doing his risk profiling. He should define an ideal asset allocation that suits his risk appetite. And basis that, he should leave it, either he has the capability and time to search for a fund for himself, or he leaves it on his advisor to choose a fund for himself. The fund of fund option actually, as Rishad said, can offer them a solution oriented fund. So where the headache of choosing the right scheme, right fund manager is all left upon on the scheme, because in the fund of funds, the fund manager decides which is the ideal scheme that is suitable for a particular solution. So I would close it at saying that the first and the foremost thing any investor should look at it is his asset allocation and his risk appetite before choosing any fund.
Absolutely. Asset allocation and risk appetite. Those are the things you need to watch out for if you're watching this special presentation to understand your investment options. Now, in any conversation around investment, can tax be far behind? Tax implications, rather. Siddharth, could you throw some light on the post tax returns of these funds and how they fare compared to active funds?
Yeah, so I think there's one change which has happened recently is that if a fund of fund is investing at least 90% of its corpus in domestic equity ETF, then equity taxation applies for that fund of fund. So typically, fund of fund faces debt taxation, but if it is investing over 90% in domestic equity ETF, then the equity taxation applies. I think it in a way levels the playing field, right? I think initially a lot of concern was always about the taxation of fund of fund as a debt scheme. But if a fund of fund, let's say, is tracking a single ETF scheme only, a domestic ETF scheme only, or multiple domestic ETF scheme only, then equity taxation apply. And from a taxation point of view, there's no difference if a person is investing in a domestic ETF or a fund of fund tracking a domestic ETF. So I think that is one very important development which has taken a few years back. Now, in terms of performance, then becomes what is the strategy of fund of fund. If it's a simple single ETF based fund of fund whose sole purpose is to provide a different investment route, then typically your performance or the fund of fund performance will be somewhat similar to the performance of the ETF and hence the performance of the underlying index. There are differences which arise. This is because of the first cost of the fund of fund, which is the TER, and some operational nuances like uh, when is the fund of fund deploying the money, when it is redeeming the money, at what price that is happening. Valuation for fund of fund is being done at the closing price of ETFs on the exchange rather than the NAV of the ETFs of the exchange, and few more. But because of these operational reasons, there may be some difference in the performance, but typically it is round about what the underlying ETF is giving. Now, in case the fund of fund is investing in multiple ETF, then the performance also depends on the allocation rules. For example, if a fund of fund is investing in a large cap and a mid cap ETF, the performance will also depend on how the allocation is happening. If a fund of fund is investing in multiple strategy ETFs, then it will depend on how the allocation is being done in different strategy or smart beta uh, ETFs. But these passive or partly passive fund of funds are outperforming significant number of active funds even after cost, because ultimately, what if I'm talking about a single scheme based fund of fund, single ETF based fund of fund, the it's a uh, simple performance which is being replicated of the underlying index and of the ETF itself. So the kind of performance we are seeing for ETF. We also see it for fund of fund. In case of multiple allocation, it depends upon the asset allocation rules also. So, like as Rishad said, there's no single answer. Basically, investors should understand what the objective of fund is and how it is going to work. At times, it will behave like a simple passive scheme. Remove the fund manager risk, active fund manager risk. Just try to give you market performance or a market segment performance. But in case it is based on asset allocation, there will be an added amount of risk over and above the passive fund because of the asset allocation strategy and the risk of underperformance which it can bring to the scheme. So again, there's no single answer, but I think it's a convenient way. Depends on what sort of fund you are looking at, and it can be a right approach to invest in a single ETF or multiple ETFs and enjoy the asset
Hmm.
allocation performance of the fund.
That's right. Let me bring in Rishad at this point. Rishad, in developed countries, the passive fund industry is well established. So, why do you think the passive investing movement was dormant in India and took a while to gain momentum?
I think in one word, it's returns. It's been as Siddharth mentioned. The passive industry didn't really pick up till a couple of years back when the pension fund started investing into ETF into the passive indexes. It's also kind of the case that 10, 15 years ago, there weren't as many institutional players in the Indian market. So there was a lot of scope for active management to generate better alpha. But as our market has become more and more developed, the scope for opportunities to make alpha have shrunk, particularly in the large caps. If you see over the last 10 years, 70% of active funds have underperformed the benchmark. So this element of returns and increasing simplicity has and increasing liquidity as well has led to many investors to realize that this is a better option. It was also the case that maybe 10 years back there weren't direct plans, so to say. So cost has become an increasing element when it comes to investing. And so passive funds naturally form, take up in investor interest. Uh, I think that's what has really led to the pickup, particularly over the last 2-3 years.
All right, Siddharth, you have a point to add here.
Yeah, so I'm like Rishad said, the two major factors are obviously performance and cost, and there's no denying that. But one more important thing, which obviously helps in passive funds gaining momentum, is the fact that you can do a lot of innovation in passive funds. For example, you can bring out a particular strategy based products. Like we have a low volatility based product which is good during the bear markets. We have momentum based product in India right now which typically outperforms the market during the bull run. Then we have several theme based ETFs, we have ESG based ETF, we have, for example, now because of turmoil on the debt side, people are lapping up to target maturity based index funds and ETFs. So there's a lot of innovation which can happen, and people like to have uh, the transparency which ETFs bring in terms of methodology, in terms of transparent portfolio, and you have a back tested result which basically shows how the strategy is doing during different market cycles. So that, I think, also has helped a lot, because when we are talking about inflows, we are looking at a significant inflow now in the target maturity segment. In fact, a decent amount of inflows on the smart beta side also. So it's not only about cost and performance now. Yes, a majority of AUM is still in the large cap ETFs. But now we are increasingly seeing interest on in the international ETFs, in smart beta ETFs, in target maturity index funds and ETFs. So I think this space will evolve more. AMCs will bring out more interesting product. I think in the end we will become a solution provider. We'll provide solutions to the investor, and then it will be up to the advisors to pick the right product for the investor, depending on his or her risk profile or the current market conditions.
Absolutely interesting times ahead for investors, especially as these investment options open up new possibilities for them. But as we head to the last leg of the discussion, Hemendra, would you recommend the passive funds route for helping investors get international exposure for their portfolios?
Definitely, yes. International diversification gives you a diversification in your portfolio, and you are not exposed to a single market. So suppose a client or an investor is in India, it makes sense for him to diversify outside India. And you have a lot of fund of funds available in India, which will help you invest outside India. For example, you have Motilal Oswal's Nasdaq 100 ETF, which invests into Nasdaq ETF in US. You have ICICI that has global fund of fund, which combines a group of countries into a single fund. You also have LRS route of 2.5 lakh dollars, which you can use in the financial year to invest directly into stocks or ETF in global markets. So you have companies like Stockle, Vested, Westcom, providing you platform to take exposure directly into the stocks. They also have curated portfolios in case clients are capable to identify a good portfolio for themselves. So you have multiple options ranging from the fund of funds to platforms which will help you invest directly into stocks in other countries. So the client should use these options to diversify their portfolios and the risk. Also, some of these countries are doing better than India. So you historically, if you look at returns of US or even if you look at Taiwan, they have been doing much better. So it offers you diversification as well as better returns on your portfolio.
All right. Well, we've been discussing the nuts and bolts of asset allocation through passive investment. Gentlemen, if there's one key message that, say, any investor watching this special presentation needs to take away from a key point from this discussion, what would that be? Siddharth, you'd like to start first?
I think investors should look at uh, having passive as a part of a core portfolio through large cap ETFs. It will bring down the cost of his overall portfolio, or can look at strategy based or a theme based or a sector based ETFs from a point of view of satellite allocation. But having said that, all the investments should be as per the risk profile of the investor. There are ETFs which uh, which may be suited for some, which may not be suited for others. The way they are constructed, their portfolio, their performance differs from one another. Within the large cap, you will find ETFs which are based on different strategies, different selection techniques, etc. So take an informed call, understand the method, understand how the portfolio is constructed, and then take a call whether it is suited to your risk profile, and then invest.
All right. Rishad, your summary thoughts.
Yeah, so I think today the number of options available when it comes to passive investing has expanded massively. Today, it's very much possible for an investor to construct a portfolio fully of passive investments, and having your core portfolio be that is can be very powerful. And I'm not just talking about equity, right? You can create equity, debt, and gold all passively. So structuring the right asset allocation to meet certain financial goals based on your risk profile, based on your time horizon, is very easy and simple today with passive funds. So that's something that is extremely powerful, and I hope many investors take advantage of that.
All right. The last word from you, Hemendra, a key point to take away from this conversation. What's that?
So the portfolios can be created. It's a mix of passive and active, but Moreover, I would like to add a point where I think from investors' point of view, they should focus more on the behavior gap. The returns that we see the fund is generating. I think all the fund managers in India and maybe abroad are doing a good job of delivering good returns on the scheme. However, the investor return when we see is much lower than the scheme return. And that's the outcome of the reason for that is the behavior gap. You're investing more when the markets are up and redeeming. So I think as Rishad said and Siddharth said, asset allocation follow to the T and behavior gap, leave the scheme selection to the advisor and choose the right advisors.
All right. On that note, it's time to bring this discussion to a close. I am confident our viewers will now glean ample know-how about the importance of passive funds to their portfolios. And with more and more fund houses spearheading the movement by offering innovative schemes that track various indices and sectors, the passive funds phenomenon will clearly have something for everyone. I'd like to thank Siddharth, Rishabh, and Hemendra for sharing their expertise with us in this session. Till next time, this is your host, Gautam Srinivasan, signing off. Have a great day, everyone.
Thank you.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.